Good morning, everyone, and welcome to Mosaic Coffee Breaks, our normal regular session. And today we're joined by Andy Harris from Hazelwoods Chartered Accountants, expert in law firms and particularly interfirm comparison and tax and corporate finance matters. Welcome, Andy.
Thank you, Howard. Yeah, good morning, everybody.
Morning, everyone. So, Andy, we're going to cover a couple of things today, but in this first lot, I know you're responsible for the Law Society's Interfirm Comparison Benchmarking Survey, and you produce that annually. It's just gone to press, and you can't actually give us and reveal the full details of what's in there, and because it's obviously embargoed for the time being. But can you start by giving us something of a flavour of what you're seeing in the benchmarking survey this year?
Yeah, sure. I've written the LMS Financial Benchmarking Survey for 12 years now. The most recent survey was run in the period up to October 2020. So for some of the firms, you've got a period within COVID, and some of the firms were before COVID. So we've got a bit of a funny situation where we're trying to interpret the data we've been given. And we also asked quite a few questions around firms' experiences at the time in terms of had they taken advantage of the VAT deferment, had they deferred the partners' tax bills, and so on. So about 150 firms have taken part in the 2020 survey, which, as you say, is going to print now, and so should be published within the next few weeks, hopefully. And the flavour really continues on from the previous year, where we'd found that whilst income for most work types was up, particularly this year conveyancing, overheads had increased by more than the increase in fees, and so they offset or outweighed the increase in fees. So despite fees going up, profits per partner are down. Last year they were down for the first time in 11 years, and we've got a second successive reduction in 12 years, which is a bit concerning, and the reduction is something like 7%, which is quite a big drop.
That's fascinating, Andy, because if you'd asked me, I would have perhaps expected a drop in fee income, but also a drop in expenses, because people aren't out and about marketing, they're not out and about traveling. And if anything, you've then got COVID support grants coming in to reduce the impact of COVID. So that seems to be going against all the trends. Any idea why?
Well, I suspect part of that is due to the timing of the data. So, as I say, some of the firms, their year ends were March, for example. Most firms in a survey have a March or April year end. So if you've got a March year end, then really it's only the last 2 weeks that were affected by COVID. And by that point, they hadn't reduced their marketing spend. So I think we'll really gauge the impact of COVID in next year's survey.
Yeah, that makes sense.
Andy, can I ask you, is it the people costs that have gone up, or is it the other overheads that have gone up? Because one of the things that's struck me for a long time is that the overhead of compliance, regulation, and all of those things has been increasingly weighing, particularly on the size of firms that are involved in the LMS survey. So I just wonder whether the sort of support staff is one of the driving issues.
Support staff numbers have dropped over the 12 years. We've done it by more than 50%. So from memory, when we first did a survey, there was something like 0.75 secretaries per fee earner, and now we're down below 1 secretary to 2 fee earners. So the ratios dropped significantly, and we've seen that again this year. And my gut feeling is that next year that's going to come down quite significantly. When you think that most of the redundancies we're seeing now are around support staff rather than fee earning staff. So yeah, staff costs have jumped, but mainly on the fee earner side. Staff salaries are still going up. There's pressure to increase salaries to retain staff, and firms are having to pay more salaries or higher salaries to attract new staff, and we see that getting significantly worse this year, because you can now have people working in Yorkshire but being employed by a firm in the city. So how's a Yorkshire firm going to compete with the city salary? So we see that getting worse, as I say, over the next few years. But other overheads are going up as well. So PI insurance, we all know that premiums last October jumped. They're going to go up again next month. But we've gone from being somewhere around 2% of fee income to nudging 4% of fee income on average,
Right.
which is, you know, it's a lot.
What about, you would say there was a drop in PEP, profit per equity partner. What sort of average PEP are you seeing, and what's the top end and the bottom end of the range?
This year's media, and I have to be careful what I tell you, because as I say, the survey has not been published yet, but it's dropped from somewhere around 170,000 to 150,000 across the 150 firms that took part. I mean, I should expect the smaller firms are seeing much smaller figures than that, but quite a big drop, bearing in mind that last year we also saw a drop of 5%. So it's quite concerning.
Isn't there, Andy, a little hint of a reversion to the mean there? Because as you know, I worked with you on the LMS survey for a number of years, and for the kind of firm that the LMS is surveying, PEP of around 150 has tended to be around average over the years, hasn't it?
Yes, I think you're probably right. Looking back at the last 5 years, and that figure has been fairly consistent. I mean, we're always affected by the firms that take part in the survey, and whilst they're generally consistent, there are always new people that come in or people that drop off.
But presumably also, if it stayed the same, but you've had inflation, so in real terms, it's gone down.
Yes. Yeah. Control around lockup, so whip and debtors has remained strong, and again, that's probably distorted a little bit because, you know, we all know that every firm got their fee in as much as they possibly could last year. So you always take those figures with a pinch of salt. It's very much a snapshot picture, but the indications are that control over lockup's pretty good. Bad debts have stayed fairly low, so that's a positive.
What else are you seeing increase, Andy, in terms of overheads? PII is the obvious one, but staff's going the other way. Yes,
accommodation costs have increased over the in recent years, not significantly, but they have generally gone up, and that's another area where it would be fascinating to see how that changes over the next 2-3 years. I mean, some firms are trying to get rid of offices as quickly as they can, and you know, there are Law Gazette articles around firms trying to get as much as they can. So it's going to be an interesting one, that one. But the profit margins are being squeezed every year. The super profit margins being squeezed every year. It's all about getting the most out of your fee earners. I mean, you know this, Nigel. It's about billing, pricing correctly, good behaviours around getting paid quickly, and getting the most out of your staff.
I wonder whether that then has
technology spend. Sorry.
Go on, Barry, sorry.
What about technology spend? I would have thought that's eating into profitability. Presumably, these days, a lot more of it is software as a service rather than capital expenditure.
Yes, you're right. It hasn't increased massively in recent years, but that's another area where we expect the current year's figures to show a big jump as firms have to spend huge amounts getting their staff working from home quite quickly. And I know here we had to buy 120 laptops in a space of a couple of weeks. So,
yep. The question I was going to ask was just interest us in terms of sort of succession planning. If staff salaries are going up and profit per equity partner is going down, do you think that then is creating issues in terms of getting people into the equity?
I think it will, and interestingly, we look at the total number of partners in all participating firms, and it was completely flat this year. I think less than a 1% increase, and that's the first time we've seen such a small increase for a while. So, I mean, there was already a reluctance to step up to partnership, and with COVID and the continued growth of people like Keystone, I think that's going to continue to get more and more difficult.
Can I just ask you something around that, Andy? And it might be something we explore more in the second half of our discussion. But you'll have seen a lot in the press recently about the rise of consultant-led firms, including a piece by our colleague Paul Bennett in Legal Futures. Is there any evidence from this year's survey of firms beginning to experiment with that model? I ask because I've got a couple of client firms that look to all intents and purposes like traditional law firms, but they have a handful of people employed on the consultant basis. And the reason behind that is they couldn't possibly compete for the salaries that those consultants stroke lawyers were looking for, but they could engage them on a you keep 70% of what you bill basis. Is that, are you seeing any evidence of that trend growing?
I'm not sure we're seeing it through the survey, but certainly with our client base, we have 10 clients now that I think would describe themselves as a virtual type firm with consultancy arrangement, and it's definitely on the increase, and people within those firms seem to really enjoy it. It doesn't always work though. There have been one or two fairly high profile virtual firm collapses. I can think of one in particular, where if the model's not quite right, and you are still spending too much on offices, then it can go quite quickly wrong.
Yeah.
Presumably one of the attractions to the firms of that is that they don't have to fund the lockup because they don't have to pay the lawyers until they get paid themselves.
Yeah, I suppose if you're providing all the office equipment, etc., then there is expense there. I wonder whether the model is going to work more where people are working from home, as we've all discovered in the past year, is much easier to do. And then you just have sort of these collaboration hubs where people can go in when they need to meet a client or whatever. So you're keeping that under control.
Yeah. What's your view on working from home? Do you think people will be desperate to get back into the offices or carry on as they are?
I think it depends very much on the person. I suspect the younger age group are desperate to get back into the office, because if you're working in a small flat share and you've got no social interaction, it's pretty miserable. Those of us who, dare I say it, are maybe towards the other end of our careers, who have comfortable houses, it's very nice working from home. But yeah, we still miss that social interaction. But I could see people sort of going, well, I'm not sure I'm going to go back to the office every day. I might do 3 or 4 days in the office, 1 or 2 days at home. That sort of model, and not just in law. I'm talking to senior people who are going, I get so much more done when I'm not being interrupted in the office. Just conscious of the time here, are there any other sort of key nuggets, Andy, about the benchmarking survey you'd like to end with?
No, I think that's about it.
Right,
that's lovely to end, is it?
Okay.
Maybe we can end it with that.
We can pause that and re-record a better ending.
I think that might be an outtake later on.